From the Volcker Alliance and the Penn Institute of Urban Research, this is Special Briefing. I'm Bill Glasgall at the Alliance, and I'm here with my co-host at Penn IUR, Susan Wachter. Hello, Susan.
Good morning, Bill. How are you today?
I'm just great. And we have a great program and a great audience today. Tell you all about it in a second. We're coming to you the day after Federal Reserve Chair Jay Powell announced the first interest rate cut since 2020. He wants to engineer a soft landing and stave off any recession. The half percentage point reduction, or 50 basis points in bond market lingo, it's likely to be followed by another 50 basis points by the end of the year and more through 2027. And our expert panel certainly has some ideas on what this all means for inflation, jobs, GDP, and state and local budgets. Our panelists today are all repeat guests on our virtual stage. See him up there on the screen. Chief Economist Mark Zandi of Moody's Analytics, Muni Bond Maven Vikram Rai of Wells Fargo, Local Government Specialist Jane Ridley from S&P, and Matt Stitt of PFM's Center for Budget Equity and Innovation. Welcome back to you all. Also, a special welcome to our friends at WISI, the Wisconsin Public Affairs Network. They're plugging into our livecast today, and to all you Badgers, great to have you and hope to see you again. And we'll get rolling in a moment, but first this word. We're coming to you live on the Volcker Alliance and Penn IUR websites, and also on the Special Briefing podcast. We've taken your questions in advance, and they're good ones, and we'll address them later in the program. And of course, this special briefing is made possible with the generous support of the Volcker Alliance and members of the Penn IUR Board of Advisors. And now let me hand the mic over to Susan to introduce Mark Zandi. Susan?
Thank you so much, Bill. It's my pleasure to introduce Mark Zandi at this moment of change when the Fed funds rate has come down after years of going only in the other direction. And so, is this good news? What kind of good news does this portend for our economy? Mark is the person to tell us. He is the chief economist at Moody's and overall macro economist that we want to hear from, and we're so pleased to be able to hear from him. Mark?
Oh, Susan, it's great to be with you. Thank you for the opportunity. Did you want me to prattle on for a minute or so about the economy?
Yes, indeed.
Oh,
please,
okay.
Go for there.
Okay, it's all good. It's all good. It feels really good. The economy's at full employment, 4.2% unemployment rate. Inflation is effectively at the Federal Reserve's target. We're creating a lot of jobs. Job growth has slowed, but that's largely been by design. The Fed increased interest rates to cool things off, and they got what they wanted. GDP, that's the value of all the things that we produce, that's growing 3%, believe it or not, 3% year over year through the second quarter of this year. It's tracking 3% in the third quarter. We could get 3% growth in calendar year 2024. That's good. Stock market's at a record high. Housing values, I know that's an affordability problem for potential first-time home buyers, but for the 2/3 of Americans that own their own home, that's a good thing that housing values are up. Debt service is low. I'm painting with a broad brush. Obviously, there's big differences across the income distribution, but generally, households have done a good job locking in the previously record low interest rates. And just to add to it is yesterday's decision by the Fed to cut the federal funds rate target, the rate they control, by 0.5 point, and signal very strongly that they're going to be engaged in a series of rate cuts going forward, and they're going to normalize interest rates, get rates back down to something that's more consistent with the so-called neutral rate, that rate at which monetary policy is neither supporting or restraining growth by this time next year. So that all feels good. And I think strongly argues that the long anticipated soft landing is at hand. That I don't know if we can declare victory that we've soft landed until we get a few more rate cuts, but we're well on our way. We got blemishes, but taking it all together, it feels really very good.
So, Mark, the soft landing is here. However, 10-year treasuries, mortgage rates, state and local, they have to pay a far higher interest rate. still, even though we had a 50 basis points decline, then historic norms, what do you see in terms of cost for borrowing in state and localities?
I think generally rates are still, they're elevated, but mostly at the short end, kind of in the intermediate and longer end, they're kind of roughly where you'd expect them to be. I mean, the 10-year treasury yield's at 3.75% last I looked. That I wouldn't count on that going any lower. In fact, I would say it probably is going to trade between 4 and 4.5% here, cutting through the volatility in the bond market and the typical ups and downs in the bond market. So, the short end, yeah, if you're borrowing short, you'll see rates come in. But if you're in the intermediate or longer term parts of the bond market, this is it. I think you should.
So you
plan on
don't
it.
see it coming down to pre-COVID levels?
No. I mean, that was not consistent with a well-functioning economy. That was a period of suboptimal inflation. The economy was struggling to really kick into high gear. Here we are, inflation is, where the Fed wants it, and growth is, in high gear. And by the way, growth feels like underlying growth, let's call it potential growth, is elevated, right? I mean, you've got a lot of labor force growth because of the immigration. I know that poses a boatload of challenges to communities across the country, but the one benefit is it is allowing for workers in industries that have been having a real tough time finding workers. And even more significantly, labor productivity growth has been very strong over the last year or so. Now, that may be somewhat temporary, but there's some fundamental things going on there to be optimistic about. All the business formation that we've seen since the pandemic hit, extraordinary, and that generally means more innovation and more productivity gains. So that would all argue for somewhat higher interest rates, higher equilibrium, higher neutral rates. So if I were a prudent planner, which I strive to be, I would count on a 10-year treasury yield, which is obviously the benchmark for all other borrowing, state and local governments, everyone else, of somewhere around 4 to 4.5%. I think that's kind of where we will be.
Bill,
So
you had some questions.
we're going to get to the impact of the muni market with Vikram a little later. But what does all this mean if I'm looking for a house and I can't be able to afford a mortgage? If I'm a state and local chief financial officer and I want to build that bridge and I'm dithering about selling a bond, what's it mean for that kind of investment?
Yes, Bill, no one in the state and local government dithers. I don't know that that's an appropriate word for, state and local government officials. They're prudent. They're waiting for rates to come in. Yeah. So I'd say in terms of their rates are a bit elevated. I mean, take the fixed mortgage rate. Last I looked, it was 6.15%, which, by the way, that's a lot of progress. If you go back at the end of last year, it was 8%. It got as high as 8%. And I do think it will come in a little bit more, but not a lot more. It's going to settle in somewhere between 5.5% and 6%. Again, that's consistent with a 4 to 4.5% 10-year treasury yield and a kind of a typical spread that you see in the mortgage market. And I think once rates get into the fives, fixed mortgage rates get into the fives, we'll start to see those home buyers really and home sellers, come back to life. You've got two things going on. One is rates are so high that no one can afford the mortgage payment. The other is rates are so high that people who already have mortgages are locked in, right? They've got because they refied down when rates were low and they've got a coupon that's sitting, in the threes. So they've not been willing to list their home. So there's no demand, no supply, and the market's gone dead. But if you get into the fives, it feels like that will bring life back into the market. Some of that interest rate lock will fade away. Affordability will improve, and we'll get more activity. Similarly, for businesses, state and local governments, property developers, the reduction in rates is very helpful, right? Particularly for those that already have debt and mortgages that are starting to roll over. It makes it a lot easier to roll that debt over, if rates are down. Again, they're still a little bit elevated, but they're moving in the right direction here very quickly. And the fact that the Fed was so strong in signaling future rate cuts has been very helpful in bringing down, all these interest rates because, those expectations are already embedded in rates. And so we're already going to get the benefits of that in the form of, a lower cost of capital. And, hopefully we get that bridge built and, that factory, put up because the rates are down.
Mark, we're going to turn, and we realize you have to leave, but I have one other question which is related to your comment that you just made, which is, do you think we potentially have long-term growth in the US that is now gone up by 100 basis points, that 3% could be?
Susan, I think that overstates the long-term case. I mean, I think right now, as of today, if you said, hey, Mark, what's the potential growth rate of the economy? I'd say it's at least 3. It could be higher than that. I mean, think about it. We're growing 3 and the unemployment rate's been rising. That's labor supply. It's all labor supply. That would argue that maybe the potential growth rate of the economy is actually north of where it's like closer to 4. I don't think that's sustainable because that goes back to immigration, and already that's slowing. President Biden implemented, put in place an executive order, and that has really slowed the amount of asylum seekers coming across the border. So that's going to show up in lower labor force growth. And I don't think the productivity growth that we've been seeing at this pace can be sustained. So no, I don't think we should count on 3% underlying potential growth, ad infinitum, for the future. But if you told me that underlying growth is 2.5% per annum over the next 5 years, it's not my baseline forecast at this point because I think it's important to be cautious here and prudent in our budgeting. But I think that's a reasonable upside scenario with a reasonable probability.
And which would be amazing shift because we
yeah.
haven't seen growth like that for decades.
Absolutely. Absolutely. So
Well,
let me ask a follow-up, Mark. Three of our panel members, Susan, Mark, and Matt, are all in Pennsylvania. And need I remind you that we have an election coming up in November. We have one candidate who says we're in the worst economy ever. Everything's going to hell. I looked at the latest Creighton University survey of Midwestern businesses, and it's remarkably pessimistic, very blah. So it's, so one candidate who's saying we're the worst of worst times, fixable, but we're in bad times. We have another candidate who's saying this is the new dawn. We have a great future ahead of us. How do you reconcile your forecast with all those people who say we're going to hell in a handbasket?
Well, 2 things. One, people are looking at the economy through their own political prism. I mean, you can see it. Go look at the University of Michigan survey of consumer sentiment, where they ask, are you a Republican, a Democrat, or an independent? As soon as you ask that question, everyone starts putting their political blinders on, and that's how they view the world. And the Republican respondents to that survey they're saying the economy is as bad as it's been since the teeth of the financial crisis. That's obviously not true. But Democrats the same, just the opposite. As soon as, when President Trump was president, they were abjectly pessimistic. So I think our politics are getting into the way of our objective thinking about how the economy is performing. Objectively, this economy is performing very, very well. I'll say one other thing, though, about that is, when you ask the typical American how things are going, many will say not so good. And the reason, in my view, is they still feel the financial sting of the run-up in prices in the wake of the pandemic and the Russian war, back in 21, 22, going into 23. And everyone, and for staples, for groceries, for rent, for gasoline, and people, everyone I meet who is feeling uncomfortable about their economy, they've got one item that they buy, generally it's a food item that they buy that is a litmus test for how they think about everything, and compared to what that price was 3-4 years ago. So I'm talking to a Wharton student, because I teach a class every once in a while at Wharton. How are things going? Well, not so good. Why? Well, I'm paying a lot more for ramen noodles. Ramen noodles. I talked to my niece, 22-year-old social worker in Philly. How's it going? Not so good. I go, why? I'm going to mispronounce this because what is it? Kombucha tea? Kombucha?
Yeah.
We're talking about moldy tea, apparently. Price of that's up very high. So, and I get it because, I'm old enough that I suffered through the 70s and 80s and felt that inflation. I know, what inflation's about. But most Americans, certainly young people, have never seen anything like this. And it is incredibly painful, and it's unfair in their minds. And they're getting ripped off, and it's taking them a while to get over it. Now, I do think with each passing month where wage growth and incomes are rising faster than the rate of inflation, which has been now the case for almost 2 years, that financial sting is fading, but it's not there yet. It's going to take a little bit longer for that to actually occur.
Well, that continues to be good news. So thank you very much, Mark. And we look forward to seeing you again on a future special briefing.
Anytime, guys. I really appreciate the opportunity. Take care now.
Mark, and before you leave,
Yeah.
just go down to your closest Starbucks and order that upside down soy funnel cake latte, and tell me what it costs and what it used to cost.
You're
And then
making
we'll-
that up,
and then
though,
we'll know.
Bill, aren't
No,
you
I'm
making
not
that
making that up.
Really? There's such a
Yeah,
thing?
really.
Okay. I'm just saying, for all the people on the call, Wawa coffee is the best. Right, Susan? You know what I'm talking
Oh,
about.
I
I
totally
know. We got
agree.
one down. We got one down the street from me.
Yeah.
It's there in
Wawa.
New Jersey too.
Yeah. All right. Bye, everyone.
Take care. Okay, Susan, you're up.
Yes, well, thank you so much, Mark. And now we turn to Jane Ridley. We're thrilled to have you here with us, Jane. Jane is Managing Director, S&P Global, and the expert on state and local governments. What is the impact of this historic decline, if any, on state and local governments?
Well, first, I want to say thank you for having me on today. It's great to be here, and I love kombucha, and so does my daughter. So in our house, yes, the price of kombucha is tracked, and it's high. But yeah, the state and local government sector, very stable, and all of really in the credits that we rate in public finance and not for profit, healthcare, higher ed, et cetera, has been for the most part stable. There are some pockets of stress, but really quite stable. And S&P is projecting the same kind of expectation in terms of where the national economy is going, probably another 200 basis points easing by the end of next year, by the end of 25. By the time we get to 26. So that really provides a nice stable spot for governments. And regardless of whether or not it is a strong economy or a weak economy, proactive management and strong governance is really what we see across this sector too.
Wow, well, that's terrific in terms of what you see in terms of strong government. We have had in previous briefings, including with you, Jane, questions about the fiscal cliff. And is that in some ways a counter to your optimism about the strong position of local and state governments?
That's a good question. And I will say, so just I'm the sector leader for local governments and work in state governments as well. But that means that S&P has about 17,000 ratings for local governments, and all of the questions funnel up to me, and I ask the analysts, there's like 75, 80 analysts that work on these day-to-day transactions, things going on. So first, that includes school districts. And in the school districts, ESSER's funding as part of federal stimulus has to be spent by this year. And I've been asking the question, are people saying that there's going to be a cliff? Are people saying there's going to be a cliff? And everyone says there wasn't going to be a cliff. And then there was a cliff in a lot of places that they had, but because it was one-time money and, if it was going to salaries, it was going to something else. But they also had a lot of reserves built up. And so our expectation, we looked through the cycle with that for all those governments that were getting a lot of stimulus dollars to say, how are you using them? When will you use it? To not say, oh, the numbers went way up and now it's coming way down. So we will keep, asking those questions. But at this point, even if there is some vulnerability for some places with having a cliff after that federal money runs out, we don't see it in most places as having a credit impact on the kind of general credit quality.
But do you see it having an impact on the outliers who were struggling pre-COVID? And I'm just going to raise, for example, Chicago.
Yes, it will. Now I could say on Chicago that I think and I was the primary analyst on Chicago for a long time until I'm cycled off right now because of limitations on how long you can get a credit. But they were a place that did it really prudently, right? Like how they used it, what they used it for, investing in certain sectors, investing in doing different things with it that way. What we're probably more concerned about is a smaller entity that might be having more difficulty getting people in for jobs and were able to sweeten up things for a few years, having a little bit of extra money, maybe not doing as much long-term planning. So one of the things that we really do focus on also is like, how much planning do you do? And if you're not doing a lot of planning, then probably chances are you have more likelihood to have, you know, some kind of cliff happening. So yes, there were definitely places, I think this is the root of your question, there were definitely places that were struggling prior to the pandemic that may not be looking that much better, but it was a little bit of a respite for a lot of places, even those who were struggling, a lot of them were kind of able to reset a little bit during that period.
And I guess
Let me ask
go
one quick
ahead.
question, and then we'll move on, and then have more questions later. One big concern for a lot of cities, you're the local government maven at S&P, work from home and the impact on downtowns, not just commercial real estate prices and tax revenue, but also on sales tax, income taxes. What are you guys seeing? And I know Matt Stitt, who comes after you, is also very concerned with this. What he hears from his clients.
Yeah, we've written a couple of papers on this over the past year because that obviously is something that you're concerned about. You see, you know, in many places, so many fewer people. And so that means not only you're not in the offices, that, you know, you're not buying lunch, you're not, you know, getting your dry cleaning done downtown, whatever. I think that what we did find, though, and we did a little bit more, we dug in a little bit deeper in the paper that we did this year. There is not, you know, when you look at commercial versus residential in most big cities, the majority of the taxpayers for property taxes are residential. And so you've already got kind of a 60-40 split there. And cities and governments in general can be very creative in how they make sure that they continue to generate the revenues. So we really haven't seen anywhere, and we've been asking pretty probing questions too. Sure, there are definitely the stories of, you know, 90s, they're, you know, 10 cents on the dollar for some of these huge office buildings, that kind of thing. But not anything that is to the point where we're seeing it as a pressure. Now, from a long-term perspective, you will have a lot more buildings that are not filled, right? And so how creative can you be in how you turn things over? That's a significant question. Like, oh, we're going to make it into real estate. I'm sorry, we're going to make it into apartments. Well, that's easier said than done. I'm sure everybody on the call has read those articles. So
thank you so much, Jane. We're going to come back to you with additional questions, and Bill is going to introduce our next panelist.
You bet. But first, this is a reminder that you're tuned into special briefing from the Volcker Alliance and Penn IUR, joined by our friends in Madison, Wisconsin at WisI. The archived editions of all of our special briefings are on our websites and the special briefing podcast. And now let's turn to Matt Stitt at PFM in Philly. Matt, give us a rundown on some of your local government clients' biggest concerns for the year ahead, and what marks economic scenarios. Is that what you're hearing from the ground up, as well as from Moody's from the top down?
Yeah, I think lots of, you know, local governments and state governments, particularly, and, you know, some of our clients that I've been working with across the country are honestly still facing the same issues they were facing a couple of years ago, maybe with just a little bit more clarity and predictability than a couple of years ago. You know, some things that were mentioned earlier, there continues to be funding challenges for many cities, particularly in conjunction, the dwindling of federal funds. That's something that a lot of local governments have had their sights on. And it's obviously the governments that do multi-year financial plans. That's being more baked into their projections. So they're coming up with newer baselines. Starting to see, you know, as some of the other panelists alluded to, what does kind of like the recovery of downtown look like, you know, after the pandemic, in terms of buildings, you know, occupancy rates of commercial buildings. Some of that is starting to be baked into projections going forward. Some of it's already been discounted, but I think a question that remains is, particularly in buildings that aren't going to be occupied to the extent they were pre-pandemic, what are they going to convert to? How quickly can they convert? And, you know, how quickly can that hit the tax base, so to speak? One of the things I did want to mention super quickly before I go into some of the other issues is that a lot of cities who have had a larger residential mix, downtown and commercial, have been a little bit more resilient. and a little bit more creative in terms of, I like to use the word creating more vibrancy to kind of get activity going in Center City where commuting activity may lag. Some other concerns though, we talked about transit. Transit has been down since the pandemic. It has recovered somewhat, but not fully. So you have some places looking at, how are they going to either fill that gap in service or fill that gap in funding, which is looking at alternative revenue streams. Affordability is a continuing pressing issue for many cities, and included in affordability is housing. Housing supply continues to be an issue, particularly for affordable housing, and the funding streams associated with that. So you have governments who are, coming more to a baseline of what the revenue streams look like today, but also with some of the pressing challenges that continue to burden them since the pandemic. Another issue that has continued before the pandemic and since the pandemic is brought up here: vacancies, recruitment and retention of local government workers. Again, this has improved slightly since has improved since the pandemic. I think most are up to past those pre-recession levels, but the population has grown, and so service challenges still continue. And some of that recovery is disproportionate across the government. So for instance, public safety officers in some cities continue to be a pressing challenge, and it was a pressing challenge before the pandemic. So even though you might have a government-wide vacancy rate of 20%, it's higher in certain functions, which is another challenge that governments right now are dealing with overtime payments and kind of looking from a cash standpoint, like how is that messing with our bottom line, but what does that mean for our future? Because, some of those positions will likely need to be filled. I think the last thing is the vacancy thing. And it's really looking at, return to work preferences in conjunction with the tight labor market. And what does that mean for local governments? And how is the vacancies potentially inflating certain fund balances in the short term? That's something that I think certain governments are looking at. In terms of the tax structures in the long term, Philadelphia particularly and some other cities have started tax reform commissions. They took the opportunity, knowing that federal funds would go away, knowing that certain preferences have changed since the pandemic, to bring together some expert minds to try to figure out, can we take an opportunity not to only protect our cash flow in the short term, but to make our tax structure more competitive, inclusive, and equitable in the long term. Kind of like, you gotta make sure you have the resources to run the government, but the pandemic did point out a lot of challenges that a lot of governments are trying to fix in real time. So I think this is an opportunity to take a long-term view while trying to figure out ways to replace revenue short-term, but in long-term, how are we going to grow jobs in an inclusive way locally and attract employers again, to really, address some of those needs that really led to, stem from the pandemic as well.
Just a quick follow-up point on that about taxes. Since the pandemic, you've got about 30 odd states by our count that have made significant reductions in income taxes and property taxes or property tax rebates. That momentum has slowed down as the federal aid has waned, and state budgets have kind of returned to trend. You're not seeing those outlandish increases. So it at the state level, it for the most part seems to be pretty darn hard to get tax increases through. New Jersey, maybe California, there's some notable exceptions, but a lot of state money flows down to cities, counties, school districts. So how do you reconcile that?
Well, honestly, from a local government standpoint, it's, local government's always the last in line, right? They have to wait. Sometimes they have to pass their budgets prior to states and federal governments passing them and make some, educated guesses on what they might get. But I think a lot of that's still yet to be seen. There is an election this year, right? That might change certain things. I do think that, when it comes to state challenges of funding, obviously education's a big funder of those. There's been a lot of local governments before the pandemic that had to heavily increase their local real estate taxes because of certain gaps in funding that they started to see not flowing from the state. But honestly, Bill, I think it's all a good question. I think states right now are in decent positions. You know, they got decent fund balances, but to your point, what options will they have forward, you know, to bring in more revenue if they need it? I don't see any short-term budgetary concerns for them, but I do think some of those longer-term state challenges that were there prior to the pandemic still exist. So yeah, but I think that local governments are always they have so many scenarios. I just remember when I used to be CFO council, we had so many scenarios because we never knew where those federal state dollars, if they were going to come, when they were going to come, and always had to prepare for if they did not, or if they were short.
Bill, may I do a follow-up question as well?
Sure.
Go ahead. Thank you so much, Matt. We will have questions for you afterwards, but one thing you said was so intriguing, which is that Philadelphia is looking at tax reform locally.
Mhm.
What are you suggesting? Do you have some thoughts on how to reform Philly as an example? In a way
Yeah.
that would lead to more tax revenue? What are you telling your folks, your clients?
So I will have to disclose I am co-chair of the tax reform commission
We've outed you. Good.
for the city. We are
Great.
in the process. We're deep in analysis right now, Susan. We're looking
It's
at
early days,
everything.
early days, but you wouldn't have taken that position if you hadn't had some thoughts about the potential for increasing local resources, correct?
Correct. I
Okay, so
think
are we going to have to wait though to hear more?
you'll have to wait. I can say this, the city of Philadelphia has some of the highest business taxes in the country, and we have a ton of tax incentives. I believe still about 27, give or take. It's also heavily reliant on the wage tax, not the property tax, like most other major cities. All of these things are being studied. I can say that we are studying the things that we believe through analysis do not make us competitive from a job growth standpoint or an employer attracting employer standpoint. And when I say competitive, it's really with the aim of focused on trying to attract employers who are going to grow jobs necessary to help lift Philadelphians out of poverty. What are the skill sets going to be needed? So it's not, tax reform is one thing, workforce development's another thing, and we really believe that you need both. But the whole goal of why this reform was started was to promote inclusive and equitable growth in the city of Philadelphia, while also making sure that the tax structure is sustainable enough, to make sure there's enough resources to serve the public in that same quest.
Wonderful. Thank you. Thank you so much, Matt. Bill, and we'll be back to you not only in the Q&A, but going forward. Thanks again, Matt, but we'll be speaking again with Q&A shortly, but we do have another guest. Bill?
Absolutely. We just saw him for a second. So Vikram, please turn your camera on. Live from the Wells Fargo trading room in Manhattan, Vikram Rai, the chief muni analyst. We've heard from Mark Zandi and our other panelists so far. A pretty benign environment for rates, for job growth, for inflation. What are you seeing on the trading floor, and how does this translate for the muni market? Demand for it, issuance of new debt at these or expected rates, and where is it going to? Give us the story.
Good morning, Bill. Good morning, everybody. It's my pleasure to be speaking here again, and I apologize for the din behind me. I had reserved a conference room, but I couldn't get the tech to work. But so yes, I will discuss.
We love the reality of being on the floor. That's perfect.
I hope you don't change your mind. There's a lot of noise in my background. But yes, I'll discuss the market. And first off, I'll say that I was surprised by the size of the cut yesterday. I was expecting 25 basis points. But then again, you can rationalize 25 or 50. You can rationalize it both ways. So the question now on everybody's minds is, so we have had an inverted yield curve for a very long time, almost 2 years. And now the curve is upward sloping again. So muni investors have waited for this. Muni investors, fixed income investors, they have waited for this for a very long time because now they want to see the cash that has built up on the sidelines. And for those of you who are on my distribution list, uh, so cash and cash equivalents since pre-pandemic versus now, there is about $5 trillion of cash and cash equivalents that has built up on household balance sheets. So the question is that will this cash flow into longer term investments? And correspondingly, will we see some of this flow into municipals? And obviously, if this cash flows into municipals, that will drive down bond prices and bring down the financing costs for state and local governments. Now, not to oversimplify things, but yes, I mean just because the curve is upward sloping, that does not mean that cash will flow into municipals, because the curve has been upward sloping for most. I mean, the last 2 years have been an exception, but the curve has been upward sloping for the longest time, and that doesn't always mean that there's cash flowing into municipals. So the question is that what could restrain investors from putting money into longer term municipals? I can think of a few worries. One is, could the curve invert again? And this is it's not much of a worry now. So periodically over the last 2 years, we have flirted with an upward sloping curve, and then we succumb to the inversion again. But now with such a dramatic cut, with such a decisive cut, it's unlikely that we'll invert again, because clearly the chair, the Fed they have made the direction of travel as in their words very clear. The curve is unlikely to invert, so that worry has gone away. Now, one of the worry that still exists, and I share Mark Zandi's optimism, but there are worries about interest rate volatility or even a rate sell-off, because despite the fact that the cut was very very large, the worry is that if inflation comes back in some sense because the Fed cut too much too quickly, then if there's some kind of a rate sell-off, and that's why the market has to kind of settle down. So these worries about rate volatility or a sell-off, that could keep investors on the sidelines for a little longer. And the third worry that I can think about is worries about credit, and this kind of dovetails into the points that my co-panelists made. Now, I'm not worried about state and local government credit as yet. I think for the most part, tax revenue growth, that even though that has been that has been moderated, it has been balanced by proactive fiscal management. And I see for the most part budgets are at or at least close to structural balance despite inflationary pressures. So credit is less of a worry in my mind, and I think for the most part in the minds of investors. Now, something that reared its ugly head again, and just as I was printing my report last week, the political gridlock. See, that will drive some fiscal stress, because see, that can't be dismissed. I mean, just see that there was this legislation that would strengthen voting rules. I mean, this is something that could lead to a shutdown and prevent the government from staying open past September 30th. See, that is it's very distressing, because state and local governments, they will need to brace for a possible curtailment of federal funding. And we know that local governments typically they need to spend their dollars first, and then they're reimbursed by federal agencies after submitting receipts. So even if the absolute impact of their finances is limited, these negative headlines, which retail investors read, I mean, that could keep them on the sidelines for longer. And then, of course, there are post-election worries, which is a moderate worry. It's not something that can be dismissed. So that is something that will keep the market on tenterhooks for longer. But despite these worries, I am optimistic about money flowing into municipals, and I will break my outlook about this money flowing into municipals into three periods. First is the next 2 weeks. The next 2 weeks are going to be volatile, despite the fact that we had a very large cut. We'll wait for the market to settle down. So these 2 weeks, whatever happens is going to be temporary. Now, the 7 weeks until the election, and I include this week, that's going to be very, very important. And just in terms of returns, you might find this information compelling, because I did. Over the last 6 election cycles, only in 2 election cycles have returns been negative. Once in 2008 and once in 2016. And again, I'm speaking about the 7 weeks until the election. And in 2016, the returns were negative because we were on the cusp of a hiking cycle. Because if you remember, Janet Yellen, she was the chair then. She hiked once in December of 2015, and she didn't hike until December 2016, and the market was expecting that. And in 2008, the Fed did a cut, but that we were in the throes of financial crisis. So this is the first time that the Fed is in is actively cutting during an election cycle. So that is a very, very major tailwind. So that's something to keep in mind, and that keeps makes me very positive about returns. So that's a very major tailwind that should actually lead to positive returns. Sorry, Bill, were you going to ask me something?
Yeah, before we go to Q&A, I know you've written a lot about tax policy. We have a million tax cuts floating in the wind from both presidential candidates. What's going to happen for those of us who live in or work in high tax states? What's going to happen to SALT, the state and local tax deduction, and probably what's going to happen to the TCJA?
So Bill, that's very dependent upon it's very dependent on the outcome of the election. Now, I know most experts they like to hedge their bets and say that okay, it's going to be a divided Congress, so nothing will really pass. But keep in mind that the outcome of the presidential election, I think it's still a toss-up. If you see where the House is concerned, right? Since 1952, the House has not flipped in a presidential election since 1952. So if candidate Trump wins, the chance that a House flips is very low. And the Senate, the math already favors the Republicans. So that's something to keep in mind, right? So if candidate Trump wins, the chance of a red wave cannot be dismissed, right? And historically, a new president carries the House and the Senate. So, like I said, it's very contingent upon the outcome of the election. Now, I think the cap on the SALT deduction is here to stay. And I published a report in which I discussed that how the cap on the SALT deduction has actually cost the federal government dollars, because something like the state and local tax collections have gone up because of various legislations that have gone into place. Uh, and corporate tax collections for the state of New York, the state of New Jersey have gone up uh, because of the cap on SALT deductions. So I think that is here to stay. I don't think that will change, though negotiations could take place later, but I think that won't change.
Thank
Vikram,
you.
may I ask another
Yeah.
follow-up question, which is, although I think maybe you had more to say, and I want you to finish up if you did, but in any case, going back, you said you were surprised by the 50 basis points as opposed to 25 basis points. Tell us more why you expected a 25 versus the 50. But also finish up if there was something that we were missing. Thank you.
No, I was just going to okay. Let me. So the 25 basis point is just that the body language of the Fed. I felt that they would just do 25 basis point because the 50 basis point cut, it reeks of an emergency cut when the economy is fairly strong. But then again, it like I said, you can rationalize both. So I had expected Chair Powell to do a 25 basis point cut and then make a very dovish statements. Because a 50 basis point cut, like I said, given that the economy is not that badly off, it seems surprising. But then again, like I said, you can rationalize it because there is some ways to go between now and the next Fed meeting, because November 7th, and the labor market could deteriorate. So you could argue that why wait for the market to deteriorate? Why play catch up? Let's catch it now. So at some level, I agree with that, but it can be seen as it can seem very political too. So I thought that maybe they won't go that far. So that is why I was surprised. And the other point that I was going to just finish up, that the 3 months after the election, in terms of returns, they're generally very positive because the market it breathes a sigh of relief that such a major event is behind them, and the market typically rallies. The only time that it hasn't really rallied is after the 2016 election because it was a red wave, and President Trump, he had made it very clear that he was going to lower taxes, and lower taxes obviously are bearish for the muni market because anything that lowers the value, the benefit of tax exemption, causes muni rates to rise.
Absolutely. Susan, well, panelists, why don't you turn your cameras on, please, for the remainder, so we can do some jump ball questions. And Susan, you want to kick that off?
Yes, and one of the questions that we have, and interesting phenomenon, is that state and local employees, the number of employees has returned to 2019 levels, but just 2019 levels, when obviously the overall economy and therefore needs of citizens, population growth, all of the above. So I'd love to ask the panelists, what do you see as the growth or lack of growth going forward in state and local employment, and more generally their budgets? And perhaps Jay,
And if I could just add to that, it's not just 2019 levels. They finally came back to 2009 levels. State and local employment just collapsed and treaded water, and now we're back. But it's remarkable. Population has grown about 6% since 2009. State and local government employment, local school district employment, it's all pretty much flat from where it was in 2009, 2010. So please, who wants to feel that? Jane, you're the local government maven.
Yeah, no, that is that's definitely true, that we have seen, the waves in that employment, in the employment levels. One of the things we've also seen with that, and I'm not going to give a reason why I think that is. I'm going to talk about it from a credit perspective. But one of the things that we have seen that comes along with that is more technological solutions. So you don't have as many people that are answering the phone that are doing something else that it can otherwise be done, by a machine. So, but what that brings with it then is cybersecurity concerns, right? If you're not keeping up with your systems, if you're employing more technological solutions, then there is a lot more vulnerability that you have on that side too. And we do see some pretty significant cyber effects. Now, for those who are hiring, and getting back to those 2019, 2009 levels, there's difficulty attracting people in the market too. So especially if you're a more rural area or something else, that can be very difficult to find workers and work from home and that kind of thing. Teachers cannot work from home. But when you have a contract and you get settled into a contract and it's in a high inflation period, that's a concern. And they're having, you're getting raises because there's affordability issues out there with housing, with everything else. So I think that's more what we look at, especially when you have locked into a contract for several years, especially at a good wage increase each year. So as it flows, we don't see a lot of changes that directly affecting how local governments and state governments work, but there are some kind of knock-on effects with that to where your vulnerabilities are and where your prices are going and your budget forward.
Thank you, Jane. Matt, do you see, maybe for Philadelphia and more generally, hiring up and therefore budgets up, or is this technology going to in fact allow fewer workers per capita?
Yeah, I think it's an interesting question that we're going to have to keep monitoring. I do agree. I think that local governments are very resilient. They always find ways to get stuff done with the employment bases that they have, and so I think there's been some adaptation through this. I think there's been some efficiencies probably gained through the pandemic in terms of service delivery. People had to be very creative, and now it's not only and it's more right sizing employment too. I think some of the service delivery is a little bit different today than it was 3 years ago, and there's still some evaluation of what is the right amount of staff that we actually need to deliver these services. But I think Jane made some excellent points. There's union contracts, wage contracts, all of those things were also either upheld or put on hold through the pandemic, which makes some interesting contributions to this challenge. I think another thing is even before the pandemic, I mean, we're in a tight labor market now, but before the pandemic, governments had started to pare back some of the benefits that frankly made them a more attractive workforce to the private sector. And, you can just retirement benefits, you can just start with that. I mean, we all know that pay has lagged. Certain government employees who were, for lack of a better word, forced to work from home during the pandemic, when they were then told that they had to return to work, they saw that as a pay decrease, right? They adapted to things. They probably saved money from less to commute, things like that. But I think that a lot of local governments are they're trying ways. They're trying to figure out what is the right workforce, what's the right work style, how many days do employees need to be in the office versus not. But I do think that combined with just the general recruitment and retention issues that governments were dealing with prior to the pandemic, it's still there, especially in a tight labor market. It's just, it's just harder to compete when you don't have as many people out there, could potentially fill the role.
So
Good point.
if I may just quickly, unless you have a follow-up, Bill?
Yeah. Just another big issue. Question from one of our attendees, which we can expand on. So employment is one issue. Housing.
But Bill, hold that, because
okay.
I definitely want to go to housing. That
Okay.
was on my list as well. But Vikram, I'd love to have your views on, are we right-sized, a very broad picture on state and local as a share of government in the United States? Or do you see it declining over time with productivity, or increasing because now is a point where state and locals are needing more talent and can't get it, but hopefully they will in the future? What are your views on that?
Well, I don't know about talent, Susan. I do know that the size of the market needs to increase more, right? So I'm a markets person. I'll tell you. So I won't answer your call. Maybe this is not the answer that you're looking for. But see, in terms of the size of the market, see, the treasury market used to be 10 years ago half the size that it is now. And the muni market was $4 trillion in size in 2013, is still $4 trillion in size. The household wealth in 2013 used to be $60 trillion, and today it is $122 trillion. So that tells you that we have not expanded correspondingly. But that also tells me that we have not invested, state and local governments have not invested properly, because we still believe in this notion of balanced budgets. Now, yes, balanced budgets, it's a very noble concept. But that also means that I think there is underinvestment going on at some level, right? So yes, deficit financing is not a good idea, but that also means that we have not had the kind of productivity gains that federal government has had, because we are always constrained by financing needs. And so I think we haven't had the productivity gains that we should have had, because so in terms of issuance, for instance, we have not taken advantage of lower rates, and that's why our issuance does not ebb and flow with rates, which it should. We should take advantage of opportunities. When rates are high, we should issue less. When rates are low, we should issue more. We don't do that. Right? So I think that's an indirect answer to your question. So I think we have not modernized our financing needs as we should have, and so I think we haven't kept in time with we haven't kept in line with times.
So what I'm hearing you just say is that, which astonished me a bit, that the Fed government has modernized. I think you're referring to the financial markets, correct?
Correct.
And so, but where I thought you were going at first, and there may be an element, is from the stunning, and thank you for this data, the stunning decline proportionately in state and local, that there are infrastructure needs out there that are underfunded and will be going, it looks like they are now and maybe going forward, or maybe that will reverse. Is that part of your, was that part of your thinking as well, or not?
No, so that is the point that I keep belaboring. that I mean, so it becomes a political statement that we are building roads and bridges the world over, right? When our infrastructure is crumbling, and the muni market is the cornerstone of infrastructure financing, and so this is the market that should have grown, and we are ESG compliant at almost every level, and we have foreign investors who want to invest in a market, and this is the market that should have grown. This is the market that has not grown in the last 15 years. It has stayed static at $4 trillion. When the corporate market has grown from 6 trillion to 15 trillion, the treasury market has grown from 10 trillion to 30 trillion, right? The MBS market has grown from 7 trillion to 13 trillion. We haven't grown, and we should have grown because there's the opportunity to grow. So you're right. The infrastructure, and that's why there is the underfunding of infrastructure that has happened because we haven't financed it.
Well, let me ask a very related question. We have about 2 minutes left. One of our loyal attendees was referring to Vice President Harris proposing major new housing investment program. Looking at the muni market, our colleague Matt Fabian, frequent guest on these mics, observed that housing bonds in the muni market issuance is about triple the 2010 level. It's one of the few hot sectors. So are we starting to see, and this is for everybody, are we starting to see a new investment wave in affordable housing through the muni market and other pipelines?
So you're right. So how the housing sector is a bright spot in the muni market, and this is we have seen a wave of issuance, and this is also because the housing finance agencies, they have managed the finances very well. They have very strong balance sheets, and they have taken advantage of credit spreads. They have and spread. So they have expanded their balance sheets and they have securitized their loans well. Unfortunately, our investors, they shy away from securitized debt, so we have not been able to expand our buy base commensurately. But yes, I do expect growth in this sector. I do expect the affordable uh, the affordable financing sector to grow, and I think the muni market will have a role to play.
Well, we're running just up against the hour, so on that kind of bullish, moderately bullish note, maybe we should leave it there. And
I will say, Bill, that as we thank the panelists, we'll definitely return to the housing question, and we look forward to all of you being back with us. And Bill, maybe you want to tell our listeners what we're planning to do next time.
Sure. Graham Dowd, would you put the information slide up? So if any of you out in the audience want to get in touch with our panelists today, please do that. Do we have our contact slides up? There we go. Fine. So all of this information is here for you now, and it will be up on the archived version on the Penn IUR on Volcker websites very, very shortly. Please do follow up. And like I said, that's it for this edition of Special Briefing. We'd love to go on, but it's the top of the hour. Thanks so much to our terrific panelists. Thanks also, as always, to our co-host, Susan Wachter, and to the Volcker Alliance and members of the Penn IUR Board of Advisors. And of course, to our multi-talented production team, Graham Dowd in New York, Noah and Ritzenberg in Washington, and Arden Jordan, Megan Schmigdal at Penn in Philadelphia. Thanks to our friends at WISI in Wisconsin. We hope to see you again. And special thanks to you, our audience, for joining Special Briefing today. We'll be back on Thursday, October 24th, 11 a.m. Eastern, with a deep dive into, economically speaking, not climatically, economically speaking, America's hottest and coolest regions. Please watch our websites and your email for details. And remember, catch up on this and all of our other special briefings on our podcast on all the major platforms. And so for now, I'm Bill Glasgall with Susan Wachter, and we'll see you on October 24th.